Welcome to Westbrook's COVID Conversation series. Today, joining me is Nazmeera Moola. Nazmeera is the head of South African investments at 91, previously Investec Asset Management. The topic of today's conversation is the South African economy and the road ahead. Nazmeera, thanks so much for joining me.
Thanks so much for having me. Much appreciated.
Maybe to kick off, Nazmeera, President Ramaphosas Sunday evening spoke to the nation and announced that on the 1st of June, we'd, as an entire country, be going down to level 3 of the lockdown restrictions. Your initial thoughts?
I was glad to hear the president's move to level 3. I was actually quite pleased with the overall address. Compared to the one we had 10 days ago, I think this was much more front-footed. There were decisions taken. So whereas 10 days ago, the president almost went out of his way to exclude all the progress. The fact that we were going to open up e-commerce, the fact that there was actually going to be incremental moves was excluded from his speech. Whereas on Sunday evening, he listed a lot of the details. And I think that was really important because it helped provide reassurance that there was careful thinking about what was happening. There wasn't a little bit of arbitrary decision making about whether or not retailers could sell open-toed shoes or not. It was much more of a substantial set of discussions. And I think I'm very happy with the progress in terms of opening up the economy, despite the health risks, which we're all very well aware of. But I was also pleased to see the president taking back the front-footedness that stood him in such good stead at the beginning of this lockdown.
Nazmeera, one thing I'd like to discuss with you today is, I suppose, a little bit of what the past means for the future. And maybe to start, in the middle of April in the Daily Maverick, I read an article of yours where you called for a stimulus plan from the president of, and I quote, I think at least 100 billion rand. Subsequent to that, the president obviously announced a 500 billion rand stimulus package, which could be broken down into various buckets and component parts. I suppose I concede that a lot of the effectiveness of this package will be based more on its implementation than necessarily on the numbers that are quoted. But maybe just a few of your thoughts as to whether what has been done up until now is enough to help South Africa recover from the status quo with COVID-19.
Enough is an interesting word, and no, I don't think it's enough. But is it appropriate given what we can afford? Perhaps so. What I would have hoped is that the UIF would have improved its systems more than they have. So we've had periods when they seem to be functioning quite well, and those disbursements to small businesses were happening quite efficiently, particularly in early May. But we're again hearing complaints of people who didn't get paid in early May. The system's not open for the end of May as yet, and there's real concern about those payments being made. So that is one area I think they could have done much more. Just improve those systems much quicker than they have, because that's such a vital lifeline to individuals and businesses at this point in time. The second one is the money coming from the government is essentially just moving things around. They're reallocating 130 billion rands of expenditure. So it's not net 500 billion rands new. It's probably a net 400, 370 thereabouts. And then the third portion is this government guarantee scheme. And that is going to be about the banks dispersing that and making that available. So far, we're hearing mixed feedback from the banks. Some are saying that they're getting quite a lot of inquiries, quite a lot of take-up. Others are saying people are hesitant to go down that road because the conditionality for firms taking on that loan is there limits on the dividends they can pay out until that loan is repaid. So there still seems to be a mixed view on what that take-up is going to be. But that's something we're monitoring quite closely.
So Nazmeera, if the 500 billion is maybe not really 500 billion, and we as a country have a need for more stimulus going forward, the obvious question is how do we fund it?
That is the difficulty, and I think that's one of the reasons why on a risk-adjusted basis, the president and the cabinet decided to open up the economy. Is on the one hand, they're faced with, do we borrow more money to try and sustain a longer lockdown, and therefore indebt the country even more so than it is already? Or do we open up and monitor the situation and see what happens? and we know what they've chosen to do at this point in time.
Your thoughts on perhaps going the IMF route?
I have mixed feelings. I think that there's certain IMF facilities that are fairly easy to access, and the conditionality will be quite limited, notably the SDR deposits. So I think there is room for us to access those if necessary, and we may well find that we need it. Because the other thing we haven't talked about is we've talked about the stimulus package. We haven't talked about the tax shortfall that's coming our way this year. And there's probably another 250 billion rands in tax shortfall that's going to arrive, which will also need to be funded. And we may not be able to fund that out of the local bond market. So we may still need to draw on the IMF to a certain extent. So that's why I'm hesitant to say we should borrow in addition to that for a stimulus package. I think we should start by trying to open up the economy and see what happens first.
Interesting. We'll have to see how it goes. Nazmeera, another one of the most topical events that have taken place in the last week is the SARB cutting the repo rate by another 50 basis points. That makes us one of the top 10 rate cutters in the world for 2020, with a total cut of 275 basis points since the beginning of the year. Is that enough with level 3 lockdown coming to help getting the economic wheels of our country turning again?
I think the rate cuts help people. All those people on deferred payment holidays from the banks that are still accruing interest, it helps. And it helps a fair bit. 275 basis points is quite a lot. However, it's not enough to get the economy going by itself. For that, we need to see what opening up looks like, what the subsequent health issues look like, but also, can we get confidence going in this economy again? Because remember, we entered COVID-19 already in recession. So we didn't enter in with growth rates of 3, 4, 5%. We entered into this health pandemic facing a difficult economic scenario. So what we need to see the government, business, labor building on this tentative ceasefire and working together of the last 2 months to actually agree on a growth plan and implement it.
I suppose the economy is not a light switch. You don't just switch it off and then back on. I suppose in the context of what you've just described, what do you think is the future for interest rates on sort of over the more medium term?
I think that it will partially depend on whether we can deliver a sustainable fiscal package and fiscal consolidation path in the budget that the Treasury is going to produce in just under a month's time. Tito Mboweni has said that he will be producing a revised budget for 2020 in mid-late June. And if there's a plausible path to fiscal consolidation that's outlined between that and some sort of growth plan, then I think interest rates can fall another 100, 150 basis points. Without that, at most, we've got 50 more.
Interesting. Nazmeera, another question I had for you. I've read some of your articles that you've released recently, and a lot of it, or some of them, have to do with the Whigby rebalancing. And maybe for those who aren't familiar with the background, the 27th of March this year, Moody's downgraded our long-term foreign and local currency debt ratings to sub-investment grade. And that means that all 3 ratings agencies have downgraded us, which of course excludes South African government bonds from the FTSE World Government Bond Index. I believe that foreign investors own about 780 billion rand of local currency bonds. And you drew quite a few parallels between what took place in Brazil and this current situation that we're in South Africa. Can you touch on that a bit for us?
So a few years ago, Brazil found itself in a similar position. One last investment grade rating, also from Moody's at the time. And in the build up to their downgrade to sub-investment grade, you saw a big sell-off in their bonds, in their currency. But what we saw was the worst point was about a week before the actual exit from the Whigby, and the actual downgrade, and the exit happened subsequently. So what it took from that is that markets tend to be reasonably forward-looking, and they tend to price in the movements ahead of time. Unfortunately, our pricing in happened during the COVID lockdown. So the chaos we saw in markets in late February, early March was partially coronavirus, but partially the growing fear that we were going to be downgraded. And you saw South African bond yields spike tremendously over that period when there was a lack of liquidity, which exacerbated the problem. But what we've seen since then is bond yields coming in dramatically. So right now, the 10-year yield is roughly where it was prior to the downgrade, prior to coronavirus, in fact. That still leaves us with 10-year yields a fair bit higher than they were relative to the short rate. As you've already mentioned, short rates are down 275 basis points, so we would have expected 10-year yields to be down at least 200 basis points in that scenario. But the fact that they are now unchanged, and we're seeing that as a win because they went up 300 basis points beforehand, is because there's a lot of fear around what the long-term fiscal consolidation path is. And I think one of my points that I keep trying to emphasize when I'm discussing with policymakers is that if we start to produce a plausible growth plan which makes people comfortable on the turnover of SA Inc., and therefore comfortable on the country's ability to service its debt, you could probably take another 100, 150 basis points off bond yields. Maybe 200 basis points at a push in due course. What does that do for your debt dynamics? Because suddenly the proportion of your expenditure every year that is used for interest payments declines significantly on new debt issued.
That's an interesting point you make there around building confidence around SA Inc. I mean, we have our challenges. We've got SAA, we've got Eskom, etc. Maybe just a closing question, Nazmeera. We're on our way out, hopefully, of the coronavirus hard lockdown. What does South Africa as a country need to do going forward if we are to be relatively less affected by the COVID-19 pandemic when compared to other emerging markets?
There are two elements. The one is we need to be much more considered on our government expenditure. That conversation had already started in February. Minister of Finance talking about no wage increases for public servants this year, no more support for SAA. Those things, I think coronavirus has made those things a necessity, not even a discussion point. So that's the one area. The second area, which is more important, is let's discuss how we engender confidence and how we get growth going. And there's some big things that are necessary. For example, getting the private sector involved in electricity generation, perhaps water supply, fast tracking the spectrum auction, which now we've seen spectrum being awarded to the mobile phone companies for a temporary period during the lockdown, but that auction needs to be fast tracked. And then on a very practical basis, just making it easier for small and medium-sized businesses to operate. Between 2009 and 2019, South Africa fell from 32nd in the world to 84th in the World Bank's Doing Business survey. And a lot of that is due to regulations that were implemented at either the municipal or the national level that were very well intentioned, but that made it much more difficult for small and medium-sized businesses to operate. Bigger businesses can deal with it because they hire another compliance person. They can afford the cost. Smaller and medium-sized businesses cannot, especially not in this environment. So what I would recommend the government does is that the Department of Trade and Industry takes a hard look at what particular measures have contributed to this fall in rankings and does a very simple assessment of whether we can just delete those regulations. Are they necessary? Have they served a purpose? They may have had good intentions, but have they actually served a purpose? And I would suspect that at least half of them, if not 3/4, are pointless. Because they have a good intention, but the execution doesn't allow that intent to be achieved. And all it does is it adds time, cost, and effort, which makes it difficult for businesses to operate and hire people.
Yeah, that's really interesting. I know I said that was the last question. I do have one final question for you if you've got a minute. And it has to do with the Rand. I mean, we've seen during COVID, the Rand go all the way out to 19 to the dollar. Obviously, with the same timing as the interest rate cut last week, we saw the Rand rally a little bit, currently trading around 17.50. I suppose the question is, at that level, is the rand undervalued, overvalued, and any thoughts you might have as to what the future holds for us?
I think that foreign sentiment towards South Africa is really negative at this point in time. And therefore, any incremental positive news flow is going to result in a stronger rand and lower bond yields. And last week, what we saw was the Reserve Bank cut a little bit less than expected. The base case was 50, but a lot of people had been speculating on 100. It cut a little bit less than expected, but more importantly, they were at pains to say that they're not going to indulge in quantitative easing. And you saw the impact on the currency and the bond yields. I mean, it's also the risk environment has turned more favorable towards emerging markets, which has also helped. But this is why we go back to the budget coming next month and this idea of a growth plan. So the good news for me is that through this lockdown and the opening up, we've seen business and government work quite well together. Even in the mining sector, talk to AngloGold, they have just shut down a mine where they identified one person who had COVID-19 due to screening, and then they did some blanket testing across the mine, and they identified another 160 odd people, all of whom were asymptomatic. And their relationship with the government has been very constructive. There hasn't been any Section 89, 189s that have been issued. What's happened is that they've agreed a plan, shut down, cleaning, screening, tracing, and they're looking to open up as soon as possible. And if we can get that constructive relationship where both parties are responsible, business takes responsibility for the parts it needs to do, and government works as a partner to that, I think we can get the best outcome and employ a whole lot more people.
I suppose all eyes on the revised budget next month. That's Nazmeera Moola. Nazmeera is the head of South African investments at 91 Asset Management. Nazmeera, thank you so much for your time.
No problem, dear.